It's a buy one, get one free here today in this one, folks, on the reaction channel. First one for me to react to, stress like it's 1987. Whenever I think about 1987, I think about the worst one-day stock market crash we ever had in history was in 1987. Evercore's Julian Emanuel questions why rate hikes are still on the table. We'll hear what he has to say in this one. I want to react to that one and give my opinion. That's from 1 hour ago, okay? This one from 6 hours ago. The government response to Silicon Valley Bank, SVB Bank, was radically different than 2008. And hear what he has to say there, because that's a game changer in terms of how the market's viewed, how the Fed's viewed, and the backstop on all these sorts of things, okay? Now, before we get into this, folks, I got to say, you have certain time periods in the market when you have to be taking this stuff serious, okay? And I feel like we're in one of those time periods right now, right? A lot of fear, a lot of uncertainty. You got bank runs going on, all this drama, okay? And so I feel like if you aren't taking the market serious over this next few months, you're just going to look back with a huge amount of regret. And this is something I was preaching, obviously, in the back half of 2022, right? And some folks were able to take advantage of amazing deals. Look at Meta stock, right? Meta was under $100 a share. Look at Tesla. Tesla fell all the way to $100 a share. Look at where Netflix stock went. Netflix was like $160, $170 a share, right? Look at Shopify stock. It fell all the way down to 25 bucks. There's tremendous opportunities in a ton of tech companies. And some of us, myself, and maybe hopefully some of you guys, got to take advantage of those, okay? And now there's a huge segment opening up in dividend stocks, value stocks, and a lot of opportunities here in 2023. And so I'm telling you, you've got to take advantage of these markets. You've got to take this stuff serious, folks. If you don't, you will look back in the future and regret. Just like people look back at what happened last year and they didn't take advantage of a lot of tech stocks and are like, oh my gosh, that stock's up 70%, 80%. And the amounts of money are like life-changing many times in regards to many of these stocks. Never mind what they'll be in 3, 5, 7 years from now. So this is one of those time periods, folks, you've got to take this serious. If it's time for you to actually take this stuff serious and you're looking to apply to join my private stock group, the private wealth group, check out the pinned comment down there. That'll be to apply to join us in there. Let's react to this.
Time on Wall Street, the savings and loan crisis and the crash of 87. Julian Emanuel is the firm's senior managing director.
By the way, thank you everybody. Subscribe to the channel. We just hit another new record of subscribers on this channel in history. So I appreciate every single person that always joins me for these reactions.
At Evercore ISI. Julian, great to have you here on set. Steve was just saying, is the bond market pricing in too much versus the equity market pricing in too? I mean, where should the two meet at this point?
So the problem here, Melissa, is if you think about where rate expectations are right now, we've just talked about it, somewhere between 3.75 and 5.25. So how can we possibly know? And the fact is until we get more clarity, and I hate to use the word data dependency, but we need to see data. But more than that, we need to see how the market responds to the data. Obviously, we won't have to wait too long for that inflation number tomorrow. But the thing is, when you think about it, no one really can make solid assumptions given that kind of variability, and that's why you're seeing the volatility in the equity markets.
Let's say Fed funds are...
To be fair to that gentleman, right? I mean, it doesn't matter what you're looking at. I would never trust the Fed and kind of what they're up to, what their decision-making is in most situations, right? Because you could even look back at the time period of late 2021 when they said they weren't going to raise. And if anything, maybe 2022, by the end of the year, we'd be at maybe, they were talking about like 0.5% Fed funds rate, maybe 1% max Fed funds rate at the end of 2022. And look what we got. We got like 4% end of 2022 or so, right? And so this kind of goes to show you shouldn't ever put too much faith in kind of what the Fed's saying at a particular time, these dot plots and, 6 months out and this and that, because at the end of the day, they can change up and they can change up really, really rapidly.
Let's say we end the year at around 375. Is that good for equity markets or bad for equity markets?
So our view is it actually could be both. And let me explain, okay. Because if what we've seen in the last week is the first shot across the bow in terms of the effective tightening, we are going to have a recession. That is Ed Hyman's forecast. We do think it's likely to be mild. And so therefore, what we're thinking is you're going to get a retest of those October lows, but eventually get that buying opportunity that we've been waiting for almost 2 years now that will launch the next bull market phase.
So Julian, I think that the data is out the window. I think that the only data that we care about right now are banks collapsing and the further collapse of banks. So I think that's taken a very distant backseat, and Tim brought this up. The market has tightened around this more than anything the chairman can do at this point going forward. So should we even pay attention if that number is hot tomorrow? Does it really even matter?
Well, we should, because I go back to last Tuesday and you think about the uncertainty. To think that you would see financial stress of this kind develop in the system 24 hours after Chair Powell suggested he might go 50 on the 22nd, it just tells you how extremely uncertain the environment is.
But that wasn't as a result of the Fed, right? That wasn't what the market has done over the last couple of days. SVB ran the market really on the same day in the afternoon. So I guess my question to you, though, as a market strategist, is has this only elongated this whole process? Everyone wanted this bear market to, and even the Fed, to be aggressive and quick and over with. But when I look at where we still don't know where we are on credit, I look at standards for banks. Again, I think they've tightened immediately, and I think the impact on the economy is something we don't know. I think it's another headwind to the economy. I guess it's a long way of saying we wanted this thing to be over with in a year. I think the events of the last 3 days have only extended the timeline for people to say all clear for another 12 months.
I differ on that. I think really, if you look at it, we were having conversations last week with clients out of all places on the West Coast, talking about how the no landing scenario was operative, talking about the idea that rate hikes were no longer able to have the kind of monetary transmission mechanism that they've had for the last 50 years. All of that's out the window. And I would suggest that, again, and look, part of the end game is we do want to see enough of a downturn to make stocks attractive, to cause this, cathartic moment where we can reset and multiples can begin expanding as the economic cycle turns. But we're still a ways from that. However, I would suggest, whereas people were thinking, well, this could last into 24, it does feel like the downturn is closer than we thought a week ago.
So basically what he's just said there is he wants to see some sort of massive capitulation sell-off in the market, right? Maybe an S&P goes down 20% from here or something like that. And then everybody jumps in suddenly all at once and then pushes the market up, and you start the next bull market is what it sounds like he's basically saying there, okay? And my point to that is that's not how this works. It never is how this works, okay? Because everybody's got different opinions on how far the market should go down, on what's a good buying opportunity versus not a good buying opportunity. It goes on a stock-by-stock basis. It goes on an index-by-index basis. And there's certain folks out there that could say, I think a forward P of 20 is fair on the market. There's other people that say, no, it needs to be 15. There's other people that say, no, it needs to be 12, right? There's other people that say, no, it should be 25. So that range can be very wide. And so this, I believe Wall Street has this imagination in their head of this huge sell-off in the market. Everybody jumps in, and then the next bull market forms, and then you go up from there. And it just doesn't work like that. I think they're addicted to that feeling because of what happened in the Rona crash, where we went straight down, straight up. I think also great financial crisis, right? Where almost all the stocks bottomed around the same time. But I've always felt like this is more of a tech bubble-ish type market reset that we're going through. And in that tech bubble situation, right, the indexes all bottomed at different times. Different stocks bottomed at different times. Certain stocks bottomed a year and a half before other stocks bottomed. And we're talking about major companies I'm talking about here. And so I just think we're more in that sort of market than a great financial crisis type market, and more than a Rona type market. And I just think they've got it very confused, and they keep looking at the wrong past market conditions that we've gone through to try to represent this market. And I'm I think we're much more along the lines of the tech bubble. And if you look at everything that lined up here, it's so identical, right? Because the tech bubble, you didn't have some sort of huge, massive recession, which is not what we're getting, right? And unemployment staying actually pretty much the lowest that we've ever seen, right? There's other problems in the economy, but it's not to a great financial crisis type situation. Oh my gosh, unemployment's going to 10%. Everybody's got to lay off everybody. It's not one of those sorts of situations, but you had valuations that got pushed way too high, right? Not to the tech bubble valuation days, but pretty darn high, way higher than they should have been. So which meant stocks had to get collapsed, right? The Fed had to step in, and ultimately definitely you had some crazy risk taking, obviously, with the cryptos and everything that was going on, the meme stocks, all that stuff, right? And so there's kind of like a deleveraging of that whole situation. So once again, I believe this market is much, if you want to compare it to a past time, compare it more to the tech bubble than you compare it to the great financial crisis or something like that. Very, very different market we're in.
And you're on the show, you're on CNBC a lot. I don't think that there would have been a time where if somebody had asked you, what's the next tape bomb you see, that you would have said Silicon Valley Bank shares or run on the banking system, right? So I'm wondering, like,
Always
now that you think
somewhere.
out in terms of the ramifications of Fed tightening and where we could see further cracks in the system, what's on your radar at this point?
I think the next thing that we really need to be cognizant of is how credit in general trades. One of the hallmarks of the last 9 months is that credit was very well behaved once we figured out that Europe wasn't going to implode over the summer. We've seen some widening over the last week or so, but nowhere near commensurate with the kind of moves we've seen in regional banks. We'll be looking at that very closely for signs of stress in the system.
Julian, thank you. Good to see you. Julian Emanuel, Evercore ISI. That's something that you've been following. I mean, are we whistling past the graveyard when it comes to credit and how relatively behaved it's been?
So the HYG, on a day that the yield curve moved the way it did, right, you would think it would be up. And in fact, it was up earlier in the day, but it closed down, telling you that spreads widened, and they widened even more because rates went up. But not even close to a warning sign or a flashing light at all. So I'm staying short that and the LQD.
So I understand the debate around what the Fed has done and what type of activity that has encouraged, right? We've had loose monetary policy for quite some time. Now we're tightening, and there are going to be some things that break. But to Tim's point, the Fed's not responsible for risk management and oversight within a singular institution. That is up to you to determine as a shareholder, as an investor, and as, you know, a C-suite executive there. And then what you mentioned about credit, as long as credit stays, I think you're looking at Fed funds and you're looking at this quick pivot. Credit is where the Fed is going to continue to focus. And as long as that stays in line, I think we're getting ahead of ourselves in terms of like
high yield spreads have widened 65 bips in 2 days. I mean, so
65 bips,
again, credit happens fast.
Yeah, but we're nowhere close to the north of 10 or 11. What are we, like 8.75, 9 in terms of high yield spreads? I mean, high yield returns. We have a long ways to go, 200, 300 basis points before you start to kind of hit that panic button.
Banks are extremely well regulated, right? Someone would posit that they're perhaps over-regulated, and somehow this still happened. And so I
understand they pulled off regulations several years ago. I knew that was going to be a disaster. As soon as I saw they were pulling off a bunch of regulations and changing a bunch of the requirements and upping the numbers and all that stuff, I knew as soon as I saw that, I was like, oh man, that's going to come back to bite us. And it took a while, right? It took 5 years for it to come back and bite us, but it did end up coming back and biting us. You can't give those banks an inch. Believe me, JP Morgan, Wells Fargo, Bank of America, all those guys, dude, we were at Goldman Sachs, we already had a great financial crisis of massive proportions if those entities weren't regulated like they're regulated. Believe me on that. You think they're just, they know how to manage their risk, they're so good. No, okay? The only reason JP Morgan, Bank of America, Wells Fargo, all those guys are keeping their stuff together is literally because everybody's on them constantly, and they have an insane amount of regulations that they have to meet, right? Which is what it should be when you're basically getting backstopped by the federal government, which is basically what happens when the Fed has to step in to save one of those guys, right? So I'm just telling you, like, more regulations, the better on the banking system. The more, the merrier on the banking system. Most other industries, no, don't do that. But when it comes to these banks, 100%. They loosened. This is why Silicon Valley Bank ended up in such a big deal. This is why, because they loosened. The requirements used to be like, $50 billion, but they were able to grow to hundreds of billions of dollars and ended up being the second biggest bank failure we've seen because they loosened up policy. There's a bunch of BS they're spouting here, man.
And I completely get your point and agree with it in terms of it was that bank's responsibility to manage their risk. But at the same time, when you're in a crisis of confidence, you think this is a regulated system. How can the regulators? There's no feeling.
They took off a bunch of regulations, man. I'm trying to tell you.
of a safety net here, and I think maybe that is
do your research.
Part of the reason this whole thing is like a vortex.
No one thought, and I think Karen brought this up. No one thought you had to worry about in Signature that 90% of the deposits were above the FDIC insurance level. So that's the one thing that's glaring going forward. But usually, what regulators do is they'll fish around and they'll change a bunch of other stuff. With the Fed, though, they are responsible for the long and variable lags to understand that.
But sorry. Well, I hear you, but if I have concentration risks as a portfolio manager and I'm invested all in one sector, I'm going to have risk committees all over the place tapping me on the shoulder saying I'm not allowed to get as much. So and when you talk about also the collateral that's now eligible to be pledged at this BTFP, what are we talking about? And this is a thing that maybe we still don't know, because there are mortgage-backed securities that are more esoteric and bizarre, even though they're based on government securities.
The risk management folks they put in for all these different financial institutions are a joke, man. I don't care if it's one of these banks like an SVB or if it's FTX. I don't care what it is. Okay, it's always a joke. You know who the person is they put? The one that's easiest to be pushed around. That's who they like. The person that's the biggest. Like, they're not going to do anything, and then they just kind of let you run wild. And they're like, oh yeah, we have a chief risk compliance officer. This is them, and it's like, dude, they're not doing anything. They're not doing a dang thing. Okay, and with these entities that have regulations taken off, like they've done, over the past many years. They run wild on that. You think they're doing a job? They're not doing a job.
Allowable. And if that's allowable at par, I think we're letting people off the hook.
Yeah. So anyways, that's that situation. Okay. Next one up here. The government response to SVB, radically different than 2008. Hear what he has to say.
He is the founder and CEO of Altimeter Capital. Joined us in an exclusive interview. Brad, it's good to see you. You're probably certainly one of the most prominent voices from an investor base that comes on from that part of the world. You have venture activity aside from everything else that you do. Can you just give me your thoughts on all that's transpired here?
I can't quite get it up like this man can get it up. Holy smokes, look at that.
Thanks, Scott, for having me on. I mean, the first thing I would say is it's just been an emotional weekend. Our community bank failed. I heard from hundreds of entrepreneurs, from schools, from little leagues, who were terrified that they had done something wrong, that they weren't going to get access to their money. They weren't going to be able to meet payroll. They weren't going to be able to, meet the needs of the kids they had committed to. And so, I was proud to see a community rally together. I know, I'm from a small town in Indiana. I know Silicon Valley's not loved. I know that Silicon Valley doesn't always do what's in their own best interest in terms of communicating. But I will tell you that what happened here this weekend in saving, and pushing to save, these businesses, stepping up with no interest loans to help people make payroll today, like our firm and so many others were doing. That is the exact same thing that was going to happen today across this country from Maine to Hawaii. Including small banks in Indiana and Florida, if the Fed had not stepped up. The one thing we know for sure now, this is not a weekend about Silicon Valley Bank. This is really a story of an entire regional banking system that was in peril. And the canary in the coal mine may have been Silicon Valley Bank. And we're gonna investigate. There's gonna be plenty of things that all of these banks did wrong. But this parabolic move in rates, right, really dismantled the hold to maturity portfolios of these banks. It was exposed that they were undercapitalized. And I think if you look today, obviously a lot of these bank stocks are down. And I've had people text me and tweet me that, see, we told you this, this isn't going to stop the contagion. To me, the stocks being down shows the perfect balance that our government struck here. We often criticize our government, but over the weekend, we had the executive branch led by the president, the FDIC, the Fed, the Treasury rally together and find a balance in the middle, a roadmap forward that averted what I believe would have been an 08 type moment, coast to coast this morning. And what they said is wipe out the stocks, wipe out the bonds, not a single dollar of taxpayer money going to any executive In fact, we're going to go find the dollars that they sold in stocks in recent weeks, okay? But what we're going to do is we're going to give the confidence to the system that their deposits are safe. Whether you're at Signature Bank, which got closed down in New York, whether you're at Silicon Valley Bank that has exposure all across this country, including Silicon Valley, and they gave us a roadmap forward for other banks. We see a lot of stress in the market today. I don't think this is the last one. We have to work through this problem, and now we have a roadmap provided by the federal government that should give confidence to depositors, not to the CEOs, not to the stockholders, but to the depositors, that you did nothing wrong and your savings are safe.
So there's obviously a lot in what you just said, and I want to go to a number of different places within what you just told me. But you said we often criticize our government, and I think it's fair to say that oftentimes a lot of that criticism has come out from your neck of the woods, from some of the more prominent members of your community, being the venture capital community, which for a while has argued that government should get out of our way and let us innovate and let our companies grow, and we don't bail people out. And now it seems like the venture community was the loudest on the digital rooftop, so to speak, screaming for help when it didn't seem to be as concerned about that in past instances. And how would you square that?
First, I would say, this debate around federalism, limited government versus a government being involved is as old as the Republic itself. I mean, the debates over the Federalist Papers, et cetera. And so, yes, I do think Silicon Valley and folks in Silicon Valley who took those positions in the past have to stand up and have to say, state their case. But when I look at what happened over the weekend, right, this is radically different than 2008. This is not a bailout for shareholders. This is not a bailout for CEOs. Their reputations are going to be destroyed.
That also was not a bailout for shareholders or CEOs either. Okay, it wasn't like, especially in regards to shareholders, like a lot of the companies that went to zero. Like the shareholders didn't get any money back. Just to be clear about that. The stocks that didn't go under were sold for pennies on the dollar, like $3 a share type stuff when they were like $60 a share, $100 a share, right? So, yeah, I don't know where he's going with that, but that didn't make any sense.
Their savings are going to vanish. It's not, if you were a shareholder of one of these banks, which you may have thought was safe, you found out that it's not. But what we did was protect depositors who did nothing wrong. And listen, we have lively debates, and we should have lively debates on this issue. I suspect that it'll be a big part of what we're going to hear about running into the presidential election in 2024.
Oh, boy. I don't even want to go there. Oh, that guy, he was interesting, man. He was interesting fella. I don't know what to say about that. Oh, man. Anyways, guys, appreciate you joining me as always. More reactions coming. Obviously, drama time in the market. If you're looking to apply to join my private stock group, the private wealth group, that will be the pinned comment down there to apply to get in there. Appreciate y'all and have a great day.